The global financial system is built on a quiet assumption that almost no one questions anymore. When a crisis becomes big enough, governments will step in and save the system before everything collapses. For decades, this belief has shaped how banks lend, how investors take risks, and how governments respond to financial instability. The expectation of rescue has become one of the most powerful forces driving modern economic behavior. But history shows something unsettling about this assumption. Bailouts work until the moment they suddenly don't. Every financial system eventually reaches a scale where the cost of rescue becomes too large for governments to absorb. When that point arrives, the safety net that markets rely on begins to disappear. The result is a dangerous illusion of stability. Markets appear strong and resilient, while the underlying risks quietly accumulate beneath the surface. This pattern has repeated across centuries of economic history. Periods of stability encourage more borrowing, more leverage, and more confidence in the system. Credit expansion becomes the engine that drives economic growth during these periods. Banks extend loans, investors purchase assets, and governments spend more freely. At first, the expansion feels like prosperity spreading across the entire economy. Businesses grow, wages increase, and asset prices climb steadily higher. But credit-driven growth always carries a hidden vulnerability. The system becomes increasingly dependent on continued borrowing. When borrowing slows, the entire structure begins to wobble. Debt that once seemed manageable suddenly becomes difficult to service. This is where financial crises usually begin. What appears to be a small shock reveals how fragile the system has quietly become. Central banks then move quickly to stabilize the situation. Interest rates are cut, emergency loans are provided, and liquidity floods the financial system. Governments often take even stronger measures during severe crises. They inject capital into failing banks or guarantee the liabilities of financial institutions. These interventions are known as bailouts. They are designed to stop panic before it spreads across the entire economy. Sometimes the strategy works remarkably well. Markets stabilize and the crisis fades from public attention. But every bailout leaves behind a long-term consequence. Risk that once belonged to private investors slowly moves onto government balance sheets. Public debt increases as governments absorb financial losses. Over time, the cost of protecting the system becomes enormous. This transformation is subtle but powerful. The financial system survives, but the burden shifts from banks to taxpayers. Economists describe this dynamic as moral hazard. When investors believe losses will be covered by someone else, they take greater risks. Banks may lend more aggressively when they expect government support during crises. Investors may pursue higher returns without fully considering potential losses. The result is a cycle of increasing financial leverage. Each generation of crises tends to be larger than the one before. To understand why this cycle matters today, we must look at history. Financial crises have been repeating similar patterns for centuries. One of the most famous examples occurred in the United States in 1929. The Great Depression began after a decade of credit expansion and speculative investment. During the 1920s, stock market speculation became a national obsession. Investors borrowed heavily using margin loans to buy shares. Margin loans allowed people to purchase stocks with only a small amount of their own money. This leverage magnified gains as prices continued rising. By the late 1920s, the stock market had become dangerously inflated. Asset prices were rising much faster than the underlying economy. When confidence finally broke in October 1929, the collapse was swift and devastating. Stock prices plunged and billions of dollars in wealth vanished almost overnight. The crash exposed massive weaknesses in the banking system. Thousands of banks had invested depositors' money in risky assets. Between 1930 and 1933, over 9,000 American banks failed. Millions of people lost their savings during these bank collapses. Unemployment surged across the country. At its peak, nearly 1/4 of the American workforce had no job. The economic contraction was severe. Industrial production in the United States fell by nearly half during the early 1930s. Policymakers realized that the financial system required stronger protections. Major banking reforms were introduced during the New Deal. The Banking Act of 1933 created federal deposit insurance. This policy guaranteed bank deposits and restored public confidence in the banking system. Another key reform was the Glass-Steagall Act. It separated commercial banking from investment banking activities. For decades, these regulations helped reduce financial instability. The banking system remained relatively stable throughout the mid-20th century, but financial systems rarely remain unchanged. Over time, political pressure and market innovation gradually weakened many of these regulations. In 1999, the United States repealed key parts of Glass-Steagall. Large financial institutions were once again allowed to combine multiple banking activities. At the same time, global financial markets were expanding rapidly. New financial instruments allowed banks to distribute risk across international markets. One of the most influential innovations was mortgage-backed securities. These products packaged thousands of home loans into tradable assets. During the early 2000s, low interest rates fueled a massive housing boom in the United States. Home prices rose steadily year after year. Banks began offering mortgages to borrowers with weaker credit histories. These loans were known as subprime mortgages. Investors around the world purchased securities linked to these mortgages. Many believed the products were safe because they were backed by real estate. But the underlying loans were far riskier than investors realized. When housing prices stopped rising in 2006, the system began to crack. Mortgage defaults increased rapidly across the country. Financial institutions holding mortgage securities began reporting large losses. The crisis intensified in September 2008 when Lehman Brothers collapsed. The investment bank filed for bankruptcy after failing to secure emergency funding. Global financial markets reacted with panic. Credit markets froze as banks stopped trusting each other. International trade slowed dramatically within weeks. Businesses struggled to obtain financing for basic operations. Governments responded with massive intervention programs. The United States launched the Troubled Asset Relief Program in October 2008. TARP authorized up to $700 billion to stabilize banks. Capital injections helped prevent widespread bank failures. Central banks also took extraordinary actions. Interest rates were cut to near zero across many advanced economies. The Federal Reserve introduced quantitative easing. This policy involved purchasing large quantities of government bonds and financial assets. These programs injected trillions of dollars into the financial system. Markets eventually stabilized as confidence returned, but the rescue came with a long-term cost. Government debt rose sharply across the developed world. In the United States, federal debt increased dramatically after the crisis. Public debt climbed from around 40% of GDP to more than 70% within a few years. Central bank balance sheets also expanded at historic speed. The Federal Reserve's assets grew to several trillion dollars. These policies prevented a depression, but they also created a new era of extremely low interest rates. Cheap borrowing encouraged governments, corporations, and households to accumulate even more debt. Global leverage continued rising year after year. By 2023, total global debt exceeded $300 trillion. This amount is more than 3 times the size of the global economy. Such levels of borrowing create enormous sensitivity to interest rates. Even small increases in rates can strain borrowers across the system. For many years, inflation remained low. This allowed central banks to maintain extremely easy monetary policies. But the economic environment changed after the COVID-19 pandemic. Governments introduced massive stimulus programs to support economies. Supply chain disruptions and strong demand pushed prices higher. Inflation surged across many countries in 2021 and 2022. In the United States, inflation reached 9.1% in June 2022. This was the highest inflation rate in 4 decades. Central banks were forced to react quickly. Interest rates rose at the fastest pace in decades. Higher rates exposed weaknesses across financial markets. Bonds purchased during the low-rate era lost significant value. In March 2023, Silicon Valley Bank collapsed after suffering heavy losses. Depositors withdrew billions of dollars in a matter of hours. The U.S. government stepped in to guarantee all deposits. The intervention prevented a wider banking panic. At the same time, another crisis was unfolding in Europe. Credit Suisse faced severe financial pressure after years of losses and scandals. Swiss authorities arranged an emergency takeover by UBS in March 2023. The rescue ended the independence of a bank founded in 1856. These events reminded investors how quickly financial confidence can disappear. Even large institutions can collapse when trust evaporates. Yet every rescue reinforces the belief that governments will always intervene. Markets begin to expect bailouts as a normal part of the system. This expectation encourages further risk-taking. Debt continues expanding across the global economy. But governments themselves face limits. They cannot borrow indefinitely without consequences. When public debt grows too large, investors may begin questioning a government's ability to repay. Borrowing costs then rise rapidly. History contains many examples of sovereign debt crises. Argentina experienced one of the largest defaults in 2001. The country defaulted on roughly $93 billion of debt. The Argentine peso collapsed soon afterward. The currency lost about 70% of its value. Inflation surged and economic instability spread across the country. Greece experienced a similar crisis in the early 2010s. Government debt exceeded 140% of GDP. International lenders provided more than 260 billion euros in bailout loans. The Greek economy suffered a deep and prolonged recession. These crises reveal an important limitation of bailouts. Governments can rescue banks only as long as investors trust the government itself. If that trust disappears, the entire safety net collapses. The rescuer becomes the next source of instability. Today, the global financial system is more interconnected than ever. Trillions of dollars move across markets every day. Government bonds play a central role in this system. They are used as collateral for countless financial transactions. Banks, hedge funds, and pension funds all rely on government debt as a safe asset. Confidence in these bonds supports the entire financial architecture. But if government debt levels continue rising, that confidence could weaken. The consequences would spread rapidly across global markets. Financial crises often appear sudden to the public. In reality, they develop slowly over many years. Debt accumulates, risks increase, and policy tools lose effectiveness. Eventually, the system reaches a tipping point. At that moment, even a small shock can trigger widespread instability. Confidence evaporates faster than policymakers can respond. The most important lesson from economic history is simple but uncomfortable. Bailouts can delay crises, but they cannot eliminate financial cycles. Each rescue pushes the system further into the future. But it also increases the scale of the next challenge, and when the next major crisis eventually arrives, governments may face a difficult reality. The cost of rescue could finally be too large to bear. If that moment comes, the assumption that has protected markets for decades will vanish, and the world will discover what happens when there is no bailout left.